Good afternoon, everyone. My name is James Bogart. I'm the managing principal of Bogart Wealth. Before I get going in the talk today, I did want to highlight I have the question and answer box open as well as the chat box open. Feel free interact, ask questions as you'd like. I'm going to do my best to answer them real time. If not, I'll come back and summarize them all at the end. Bogart Wealth is a registered investment advisory firm. We specialize in financial planning, tax optimization, tax preparation, and investment management. We've got 16 folks on our team. I've added a couple new faces lately. Even Sydney just joined us recently. She hasn't got her picture yet. We've got 3 offices, one in McLean, Virginia, one in Houston, Texas, and one in the Woodlands, Texas. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. You know, we found that your kids and your parents could be some of the largest variables to anyone's financial plan. We've made it part of our firm's culture to be able to give your children access to certified financial planners. You know, I like to frequently say, what would you do differently now that you know what you know, but maybe back when you were in your 20s or 30s? And for any of these talks that we do, you know, one of the calls to action is to give you the opportunity to sit down for a one-on-one financial session. There's absolutely no cost, absolutely no obligation for anyone who hasn't taken us on the opportunity. They're extremely customized, very good output and product. We like to use it as the opportunity to get to a baseline, establish where you're at, but also use it as an opportunity to get to know us. Now, these events are all part of this Retirement Cash Flow Optimizer series that we've put on. We do one on the retirement planning timeline. We do one on Social Security and Social Security strategies. We do one on tax planning as well as tax optimization strategies, one on estate planning strategies, one on net unrealized appreciation and post-retirement strategies, one on long-term care insurance, and then we also do one on Roths versus traditional 401ks and IRAs. You know, Bogart Wealth, part of our why is to educate, and we do use the opportunity as best we can to educate on any recent updates or things that are changing. You know, if there's a topic that you would like to hear and we're more than willing to add it to one of the existing talks that we do, or we'll create some new ones all on their own. For example, we did one on the CARES Act. We've also done one on the Secures Act. But if there's something you'd like to hear, please feel free, let us know. All right, so today I'm going to spend a little bit of time at the beginning talking about why we need to be focusing on retirement income planning, what's important to you and some of the variables that come into the equation, and then looking at risks in retirement. And then we're going to get into the process itself. So I'm going to talk about retirement analysis. We're going to talk about investment strategies. I'm going to talk about different withdrawal strategies and things that you want to be considering when you get into more of what I call the maintenance mode. So reviewing and monitoring your situation. All right, so just jumping in. So really, why retirement income planning? You know, the whole purpose of having an income plan is so that we can plan for and minimize risks that any retiree is going to see. And obviously, we're never going to be able to predict every single risk variable, but we know with having a plan and a baseline, it enables us to be able to make much better and more informed decisions, not only leading into your retirement, but while we're in retirement as well. We're going to need to look at what we estimate your expenses to be, and this will also help us establish from an investment perspective what is a very predictable and reliable income stream. We then also want to determine a sustainable withdrawal rate and have a withdrawal strategy appropriate so that you don't outlive your money. And then lastly, we're going to get into that maintenance kind of reviewing and monitoring. You know, but we want to create income from your portfolio that's fundamentally different than building wealth. And one thing that we didn't really bring up in here is talking about some of the tax optimization, because we do genuinely believe that one of the main priorities in terms of a distribution strategy is going to be keeping more money in your pocket, which is going to ultimately be caused by paying less in taxes. And so talking about some long-term strategies that will reduce your tax burden and tax optimization. So it's important to set the stage by defining what's important to you. And one thing that you'll hear me mention a couple times this afternoon is we need to create your vision for retirement. And a lot of times we get asked the question of, you know, am I a lot like my colleagues, or am I in good shape, or am I in bad shape? You know, and the one thing I'd always answer is no retirement is the same. Everyone's vision for retirement is a little bit different. And it's important to set the stage for what's important to you, you know, and so for a lot of folks, it's family. You know, what impact will family have on retirement plans? Might be health. Are you going to be both mentally as well as physically active throughout your retirement? And what changes in you or your spouse's health can impact your retirement plans? It might even be parents. I know a lot of folks who retire to be able to spend some more time with their parents before they ultimately pass on, or they might need somebody to help take care of them. Home, where do you plan on living in retirement? Are you going to downsize? Are you going to buy a second home? It might even be lifestyle goals. What activities are going to give you the most satisfaction? Some folks, it's working. I do know folks that retire and ultimately want to have a second career doing something, or maybe they just want to have something part-time while they kind of transition into the phase of retirement. Legacy, do you intend on leaving a legacy to loved ones or charitable causes that you support? And then lastly is mind and spirit. What do you really want out of your retirement? And all of this kind of helps us set the stage for creating the plan for retirement and how you want to live it. Now, we talk about some important goals for retirement, and 79% of folks in the survey that we did said that they wanted to have a secure, reliable retirement income stream. 73% said they wanted income that keeps up with inflation. 58% said they wanted to not worry about having enough money. 22% said they wanted to be available to help out children or grandchildren financially. 19% said they wanted more time for sports and recreation. 17% for volunteering. 5% to go back to school. 2% to be able to make philanthropic contributions. The interesting thing about this survey is the top three all have the same theme. They're all having to do with money. And it's important to kind of set the stage when we talk about goals and what are your goals in retirement. Everyone's going to be different here. And so we're also setting the stage for retirement income planning. It's important to understand some of the big risk variables. And some of the biggest ones that we see are longevity, inflation, market performance, and healthcare. When we talk about longevity, for a couple that average age is 65, there's a 49% chance that one of the two of them is going to live to age 90, 20% chance that one of the two of them is going to live to 95, and a 4% chance that one of them is going to live to 100. So people are living longer. We want to make sure that part of your plan is that we don't run out of money. Inflation. Inflation is a very real thing, especially when we're talking about the longevity of someone's retirement. A lot of people say, well, we haven't had inflation or much inflation in the last few years. Well, I would also make an argument that based on what stimulus we just saw, we're most likely going to see a lot of inflation on the other side of this. But a 3% inflation rate will reduce your purchasing power. So $50,000 today is going to have the equivalent of $23,880 in 25 years. So your money today is not going to be worth as much as it is now in the future. Next is market performance. Whether it's sequence of returns or volatility, we need to have some plans in place for both of these. Low and negative returns, especially early on in retirement, can be very detrimental to your portfolio. Just like market volatility and having to sell assets when the markets are down can have a significant long-term impact. And especially with what we've just gone through with the market correction associated with this recent recession. Got to have a plan in place. And if anything, these types of environments really enforce why liquidity is so important to someone's financial plan, especially in retirement. Healthcare costs. Now, this is really specifically talking about long-term care costs, but healthcare costs are without a doubt rising faster than inflation. And just to give an example, a couple the age of 65, it's estimated that they're going to spend $230,000 in retirement for their long-term care needs. So we need to make sure that there's funds available to cover those types of costs as well. And the reason that we talk about risks, and by the way, these are just four of some of the many risks that we have to talk about in retirement, but we need to talk about risks to be able to help and manage issues that we have little or no control over. Now, part of this, we've got to rely on historical average to help us forecast needs, whether it's your spending, what you historically have spent, what your family longevity has been, what historical market returns have been, tax assumptions, inflation assumptions. For example, with taxes, we know in 2025, at the end of 2025, tax rates are going to go back up. And that's just one level of assumptions. Each one of these is going to have different nuances to them. But because of that, there is absolutely no such thing as an average retirement. And so what we're doing is developing an approach to be able to help with mitigating and planning for not only what we can expect, but what we can't expect. And that's why we start with talking about retirement analysis. Then we get into investment strategies, we get into withdrawal strategies, and then lastly, kind of how we monitor and review it. So with it, it's important to understand what makes your retirement unique from anyone else. You need to prioritize lifestyle goals and set some realistic expectations on financially being able to achieve them. How much income are you going to need? And it's not uncommon to see those income numbers change. Typically it's very common early on in retirement. You're very active. We call that the go-go phase. And then ultimately you're going to start to transition into what we categorize as the slow go phase. And then lastly, it becomes the no-go phase, where typically those that are in their late 80s and 90s, they're not as active as they were when they retired in their late 50s or early 60s. And when we talk about expenses, we talk about what's essential, which we would categorize as needs, versus what's more discretionary. And then we want to have a plan for unexpected expenses and or wealth transfer goals, helping kids out or charities, whatever is important to you. But when we talk about spending, the essential expenses, again, the needs, this is really talking about food, housing costs, healthcare, insurance, etc., compared to your discretionary expenses, which would be more entertainment, travel, gifts, country club memberships, etc. I always find it very interesting to see when you're talking to a husband and wife, who categorizes what as wants versus who categorizes others as needs. For example, the new Mercedes every 3 years, one of the husband or wife might say that's a need, and someone might say that's just more of a discretionary want. But it's always important to have that understanding, especially when you go into retirement. Yeah, that is a need. All right, so then we want to be able to set aside for emergencies and any unexpected expenses, but also we want to be inflating these numbers. We want to know what you need to spend today and adjust that for those cost of living adjustments. Neat little chart here. This was a U.S. Department of Labor survey that was done at the end of 2018, released in 19. But what it's doing is it's breaking down spending, and this is nationwide. So you'll see the median numbers a little lower than the typical household in Northern Virginia or in the Texas markets. But it's breaking down age bands, and then it's talking about the changes between each of the categories of spending. And so for a household that's 55 to 64, again, national median spend is around $66,000. And then as you transition into that next phase, the 65 to 74, we find that expenses drop about 15%. However, you'll notice two categories actually increase, and that's typically entertainment and healthcare. No surprise there, right? And then when we get into the 75 and beyond, we notice that there's an even bigger drop in expenses. Now, typically, this is saying about 23%. And the only one that's increasing now would be healthcare in that category. But it is showing on average, people's spending does start to slow as they get older in life. And that's all we're trying to illustrate here. And then we want to make some assumptions around inflation. And again, we know inflation lately has not felt like a very big driver, but it absolutely is real. And also one of the things that I think is important as we're building a retirement income plan is we want to actually make sure that we're modeling healthcare and be able to monitor healthcare increases faster than the typical rate for inflation. Now, in order to really appropriately pull together someone's financial plan, we need to understand what their income sources are. So for example, Social Security, employer pension plans, might be personal savings and investment, might be any type of rental income, business or employment earnings, might be inheritance, sale of a house, potentially even a reverse mortgage, and determining a plan that works with a critical level of assumption. So when we jump in and we talk about income sources, the three most critical pillars of income sources are Social Security, pension income, and savings and investment income. And again, every household is going to be different here. Now, the one thing to talk about with Social Security is Social Security was never designed to replace 100% of anyone's income. Hypothetically, it was going to replace about 90% on a household that can live on about $11,000 a year. And theoretically, it will replace none if you have an unlimited income stream. I'd love to meet you. But ultimately, it could replace less than 1% of what your income is if you're a very high income earner. For the typical median household in the United States, Social Security replaces about 40%. For the typical energy employee, oil and gas employee, we find it replaces anywhere from 10 to 30%, depending on what their salary is. And here's just a real quick example that's explaining this. So Social Security, if you lived on $11,520, it's going to replace about 90% of your income. If you live on $69,420, it's going to replace about 42% of your income. And if you live on $137,700 a year, Social Security will replace 27% of your income. And as you spend more, that replacement ratio goes down lower and lower and lower. So that's just kind of illustrating the point that Social Security, again, never was designed for any household to replace 100% of their income. And then next we talk about pension income. Now, the typical pension program now, and we can model a lot talking about the ExxonMobil pension program because we do work with a lot of ExxonMobil households, but that pension program was never designed to replace 100% of anyone's income either. So it's on the low end, it's going to replace about 12%. On the high end, it's about 65%. But the formula itself is very stagnant. It's 1.6 times years of service times the average pensionable pay. There's a little bit of a Social Security offset if you're retiring under the age of 62. But for the typical career, for example, ExxonMobil employee, if you're retiring at age 60, that's 50% of your income. And here's just kind of the model for this. And I love this slide. This is actually one of the legacy pension program slides. You can see the calculation. And here it is, 1.6 times years of service times average pensionable pay minus the Social Security offset. That gives you your single life annuity option. Here's the reduction for Social Security. And that's ultimately what gives the lump sum number. Now, this was the old documents they did back in 2007. The tools have refined a little bit since then. They've got an online projection tool that's a little bit better. But I like it because it shows the formula itself. And again, I talk about replacement ratio with the program and ultimately how that pension program grows. I mentioned that the typical 60-year-old, the pension program will replace about 50% of their income needs. Well, what we're looking at here is just showing how that pension accumulates and grows. But for example, on the y-axis, we're talking about income replacement ratio. On the x-axis, we're talking about the age at which you retire. So for somebody who's retiring right at 15 years of service, right at the age of 55, it's going to replace about 12% of their income. And ultimately, if you're retiring right at that 15-year mark, you'll see a little bit of an accumulation, about 5% per year. And again, that's assuming that you're retiring, for example, at 57, right with 15 years, or at 60, right with 15 years. If you're retiring at 16 with 15 years of service, it's about a 20% replacement ratio. Excuse me. Now for the lifers, those that are a little bit longer, for example, if you're retiring at 55 with 33 years of service, you'll see about a 34% replacement ratio. And for this category, you're actually seeing about an 8% per year accumulation all the way up until the age of 60. And then you see it start to slow and only grow at about 3% per year. I had a question come in. What is the breakdown of the interest rate for the pension program? It is composed of several government matrix. Yeah, so I have a whole presentation, by the way, on this, and we do send out a weekly update on what discount rates are. Now, within the ExxonMobil category, there's two categories of households for their pension program, those that are grandfathered and those that are not. For those that fall into the category of grandfathered, basically your birthday was 1957 or earlier. The math is very simple. It's 95% of the 30-year Treasury rates. For anybody who was born 1958 or later, the math's a little bit more complicated. So what it is we actually use 3 segments, segment 1, 2, and 3. Now, segment 1 is supposed to replicate short-term, high-quality corporate bonds. So it's corporate bonds, not Treasury rates. Very different in terms of the categorization than what we saw from the grandfather category. So segment 1 is applying to the first 5 years of someone's retirement. Segment 2 is supposed to replace intermediate term high quality corporate bonds, and that's supposed to cover the next 15 years. And then segment 3 is long-term corporate bonds, and so that's going to be any level of time from year of retirement up to that age of mortality. We have a really cool little pension calculation tool that we can show you and help modeling with what different interest rate assumptions. But for both categories of households, grandfather and non-grandfathered, we've seen those discount rates come down dramatically. Grandfather category right now is projecting to see the fourth quarter rate somewhere around 1.25%. The non-grandfather category, which I'm imagining is related to your question, sir, is going to be also at historic lows. For a 60-year-old, we're projecting, I believe it's somewhere around 2.51%. For a 55-year-old, someone retiring at age 55, it's going to be somewhere around 2.6%. Either way, the lowest they've ever been in the fourth quarter. Again, for both categories, we have to finish out the month of June to get the official rates. But right now, everything I'm talking about is projections. But it is looking like both of them will be at new absolute lows as of yesterday in the month of June. All right, back to kind of talking about these income sources real quick. So let's just say hypothetically that Social Security replaces 10% of what you need to spend. And let's say that your pension replaces 50. Well, that's 60%. I don't know a whole lot of people who retire and all of a sudden want to live on 60% of what they were making. And so ultimately that gap needs to be made up for with any type of savings and investment income. And that's ultimately why we talk about the different investment strategies. Now, with what I'm proposing here or talking about today, I'm not going to make a recommendation of any particular strategy. I'm just trying to educate. But the 5 most basic strategy elements that anyone talks about for retirees really are using annuities, and it might be fixed annuities, index annuities, or variable annuities. It might be using bond ladders. It might be using income-oriented investments like big dividend-paying stocks, might be some preferred stocks, might be some master limited partnerships. And then the other approach, the fourth approach, is really what we call modern portfolio theory. It's indexing. It's more of a passive approach where we set up an asset allocation model and we rebalance it over a certain period of time. Sometimes it's monthly, sometimes it's quarterly, sometimes it's annually. And then the last approach is something that we would call dynamic. And the whole concept with dynamic is that we need to be able to move an investment strategy dependent upon what the markets are doing. Fundamental fact, though, is emotions can destroy a financial plan. And that's why having a system and process in place is so imperative when it comes to investment strategies. Emotions, fear and greed can lead to buying high and selling low. I will tell you, humans are wired completely backwards. We are okay investing when things feel good, but when things are painful, we want to go and be in safe places. And the concept really is we need to, as best we possibly can, reverse those emotions. When the markets go down, that's when we actually want to be buying, not selling. And we just lived through one of the most volatile periods of time we've seen in the last century. I mean, the correction we saw in that 3-week period of time was very painful, and it really did test an investor's risk profile. But having a process in place to be able to help and making those help prevent someone from making those bad decisions when things get really, really volatile is really, really important. We want to build a portfolio that's going to protect on the downside. We want to protect essential expenses with some type of foundational income stream. And then we want to be able to employ different strategies in volatile market environments. And I'll talk about withdrawal strategies and spending strategies in a minute. But to give you a quick overview on annuities and the basic annuity options, and I'm talking about annuities that are outside of the company offered annuity plan. This is if you decided to take a lump sum and then go buy an annuity. There are fixed annuities, index annuities, and variable annuities. Now, with a fixed annuity, the easiest way of describing it is this is a lot like a bank CD. It's got a fixed rate of return. So typically these have longer durations. They might be 5 years, they might be 10 years. And all of those funds are held in one big general fund. I want to flip over to kind of the extreme to that, which is variable annuities. The easiest way of describing variable annuities is they're a lot like mutual funds. Some insurance salesmen like to call them mutual funds with airbags, buffers. They've got safety measures around them. They are very similar to a market rate of return. And each variable annuity is held in a separate account. So your money is segmented away from everyone else's. And then in the middle is index annuities, which are kind of a hybrid of fixed annuities and variable annuities, where you can select to participate on a certain amount of the upside in order to prevent a certain amount of downside risk. Typically, you'll see a cap. Usually, the ones that we're seeing lately are anywhere from 6.5% to 7.5% on the high end, and they might give you only 5 or 10% downside limitation. So if the market goes down below a certain threshold, you can't go past that threshold. And with indexed annuities, these are all in the general account. The big negative I see with annuities, especially ones you go out and buy, are really the fees associated with them. There are some great options that aren't necessarily as expensive, but I would say for anyone, for example, from the ExxonMobil world, if your risk profile is dictating needing to have some guaranteed cash flow, I do really like the annuity options that ExxonMobil does provide for that regards. And the nice part is it's no longer 100% option for lump sum or 100% for annuity. You have the ability to do 75, 25, 50, 50, 25, 75 in terms of flexibility of lump sum versus an annuity income stream. So for me, as we're going through the planning process, depending upon someone's risk profile, we have that discussion. And an annuity typically is really what I call an emotional versus financial decision. Emotionally, it feels really good to have that income stream. Right now in this environment with interest rates so low, it is still financially favoring the lump sum. But again, we go through all of those different iterations with the household. All right, bond ladders. This is a really simple example of a bond ladder. This is just throwing a three-year, three-rung 3-year bond ladder over a 6-year period of time. And so think of it this way: if you've got $300,000 to invest and you just want to get income stream off of it, well, you would actually want to do a 1-year bond first. And again, this is for illustrative purposes, but you do a 1-year bond first for $100,000. Then you do a 2-year bond for $100,000. Then you do a 3-year bond for $100,000. As the 1-year matures, you buy a new 3-year. As the 2-year matures, you buy a new 3-year. And as the 3-year matures, you buy a new 3-year. Think of it like a ladder. And you're living off of the income that's coming in off of a bond ladder. The big issue I have with bond ladders right now is, in order to get any level of appropriate income off of them, you've got to go really far out with some of these durations. You're having to buy a lot of 30-year bonds right now, which for a retiree, that may or may not be appropriate. It's such a low interest rate environment. We can have that discussion. But again, it's all a function of someone's risk profile. So when we talk about yields that are coming in off of these things, for example, bond ladders are anywhere from 2.8 to 4.7%. And again, to see that 4.7 number, you're really pushing it in terms of timeline. It's a lot of 30-year bonds. We'll compare these to some income funds. So for example, AAA rated corporate bonds now are anywhere from 1 to 2.5%. You can still see some flexible income funds at 5.3%. Mortgage bonds are typically 1 to 2. International bonds are really not paying anything right now, down to 0.1. And then we'll compare them to preferred stocks. So preferred stocks are at 5.35%. Royalty trusts and limited partnerships are anywhere from 7 to 19%. Dividend paying stocks, you're seeing typically high quality dividend stocks between 3 and 7% roughly. And we compare all of that to 0.7% on the 10-year Treasury. So point is that in order to get any level of income off of a lot of these income investments, we're going to need to take on some level of risk. And we compare all of this to just U.S. Treasuries. So the dotted orange line is what Treasuries were at a year ago, and you can see the blue line is where they're at right now. And it's looking at the 1 month versus 2 month, 3 months, 6 month, 1 year, 2 year, 3 year, 4 year. We're still seeing the yield curve increasing a little bit. A year ago we had a little bit of a dip. But I mean, we're seeing the 30-year Treasury right now, as of the 29th, at 1.49 or 41%. I mean, that's historic lows. So even high quality Treasuries, we're not getting a tremendous amount of income off of these things. And so that's where we start to have to introduce some level of risk. So one of the income oriented approaches that we commonly talk about, and this is a portfolio that Bogart Wealth manages called Prime Income. Not making a recommendation here. I'm trying to illustrate the point. And we do it to compare against ExxonMobil stock. Now, ultimately, this chart stops as of at the end of 2018. But what we're trying to illustrate is the difference between individual stock that still pays a good dividend, however, not very diversified. And we're living through that pain right now with ExxonMobil prices being as volatile as they are, compared to a much more broad-based diversified approach. But we can see, in the left side of the chart here is just looking at the market value. And what we're doing is we're stripping out the dividend income, because again, this is assuming from an income-oriented approach that we're going to be living off the dividend income. But it's still important to talk about performance and how things have performed. So Prime Income, for example, goes up, it goes down, but you can see ultimately over the last 19 years, excuse me, in this example, it's done pretty well. And we'll compare that to ExxonMobil stock. And honestly, if I actually included recent price history, we're going to be back to almost back to even, unfortunately. However, someone will still make the argument about the dividend. And I agree with the dividend, right? So ExxonMobil for the last 37 years has not cut their dividend yields, and I commend them for that. Now, what we're looking at in the red is the ExxonMobil dividend, again, same time frame, versus a more diversified portfolio dividend yield. Now, you will see that the diversified portfolio in certain periods of time, sure, the dividend has gone down a little bit, but ultimately the trend has still increased at a faster pace. So the point we're trying to illustrate here is a dividend-oriented approach, have some diversification, and ultimately, one of the things that we're talking about a lot these days is where should we position a concentrated position in ExxonMobil relative to an overall portfolio strategy. And I still believe diversification is the way to go. If we're looking for a solid cash flow stream, I like being in big dividend blue chip stocks. I call them aristocrat stocks that are going to be around no matter what the market environment is. And ultimately, the goal really is to be in ones that are going to keep their dividend intact no matter what the market environment is. And I think that that's one of the things that's really important when you're talking about a dividend-oriented type of approach. Again, prime income is just one illustration. It's one of the portfolios that Bogart Wealth manages. But it's important to talk about a lot of different approaches when it comes to creating an overall investment strategy. All right, so I want to also compare against more of a passive approach. This is where we set up an asset allocation model, and ultimately it's driven by someone's risk profile. And the concept here is that if you have a portfolio that's 100% stocks, you're going to be okay with a certain level of return, but you're going to have a lot more volatility. Whereas if you have a portfolio with 100% bonds, you're going to get a lower rate of return, but significantly less volatility. And the concept with asset allocation is that if you blend the two, if you create a portfolio that's 60% in stocks and 40% in bonds, you're going to get a much more consistent rate of return long-term with less risk. So for example, a 40% stock portfolio, 60% bonds, you're actually going to get a better overall return with less volatility than even if you were 100% in bonds, and bonds are supposed to be more conservative. Same goes for a 50-50, and then ultimately if you increase the mix to about 60% stocks, 40% bonds, you're going to get a little bit more exposure there. Now, the one thing that I'll say with asset allocation is I think it's a phenomenal strategy, especially when we're talking about the accumulation phase of life. We're building wealth. We should look at rebalancing the mix to make sure that we're staying within target allocations. The thing that I find is an issue with asset allocation models, or at least a completely stagnant asset allocation model, is that it does not necessarily address for cash flow needs in a down market environment. So if you really are fundamentally believing in just kind of the passive indexing approach, great, I'm all for it. However, we need to have a cash flow strategy in place in order to be able to not have to sell when the markets go down. Great example is what we've just gone through, and ultimately the markets themselves still aren't even back to even. We need to know where the paycheck's going to come from so that we can emotionally not disrupt the investment strategy when it comes to market corrections, because they're guaranteed to happen. All right, dynamic asset allocation. And the whole concept with dynamic asset allocation, it's easiest to start with kind of an illustration. At the beginning of the 20th century, railroads represented 63% of the US equity markets, and just a century later, 0.2%. At that same time frame, Russia, India, and Austria-Hungary represented 25% of the global equity markets in 1899, and then less than 1% a century later. So the whole idea is that the market will change, and what is working at one point in time won't always work. You're also going to see periods of time with significant sustained drawdowns, 2007 to 2009, 2000 to 2002, 72 to 74, 68 to 70. These are prolonged intra-year declines. And ultimately, who knows how the rest of this year is going to play out. I mean, we did see one of the fastest declines in market history. We've also seen one of the fastest recoveries thus far. We're not back to even, but tremendous amount of volatility. And ultimately, I still think it's appropriate to have an investment strategy for this type of market environment as well. But when we talk about dynamic, dynamic is not by any means trying to time the market. Get in when things are good, get out when things are bad. It's a process, and it's looking at actual trends, not beliefs or predictions, creating a flow of funds to help with understanding certain factors and being able to react to geopolitical concerns, economic upturns, downturns, industry or sector opportunities, things with interest rate changes. And what it's doing is it's ranking and scoring every single asset class against each other. And so it's even going to look at cash, by the way. So cash, if cash is performing on a relative basis better than US large cap growth or international value, whatever the sector is, it's going to rank and score them. And ultimately, that's what determines the asset allocation model. And here you can see just very basically, if you look at one of these, this is an investment, we call them the investment pie chart or index chart, excuse me. You can see looking back for the last 20 years, not every year did we see consistently where everything was done relative to each other. Where, for example, we saw, emerging markets did well one year, did well another year, but then a couple of years later, it was significantly lower. So the idea here is that not every asset class is always going to be the best asset class to be in. And so ultimately, you might want to have an approach where you're going to see some flexibility therein. Got asked, how is the ranking accomplished? So again, it depends really on what the dynamic matrix is in terms of what relative strength algorithms are using. Some of the ones that we're watching very closely are overbought versus oversold indicators. That's one of them. We look at the 10-week moving averages versus what's overbought, what's oversold. We also look at 50-day and 200-day moving averages. And those are some of the matrices that go into when we buy or sell something. But again, this is just one strategy, not necessarily making a recommendation here. But the concept with a more dynamic approach is that there will be periods of time where you may want to change what sectors you're in. And candidly, I look at this environment. Like right now, one of the main conversations I'm having with investors is, where do we want to be positioned post-COVID-19? It could be months to years before we see a vaccine or some type of cure. But we all know life has to go on. And same with our portfolio approach. We can't sit in cash this entire time. But when we look at certain parts of the economy, we know, for example, there are sectors that are going to get impacted more. For example, travel. I mean, look at airlines right now. I don't think airlines are going to be back on track for minimum 18, maybe even 36 months before we see airlines getting back to where we were. People don't want to get on airplanes. I get it. Energy, I put in that category as well. I mean, demand was gone. I mean, and ultimately, we talked about 8 weeks with absolutely no demand. Now, I do think that things are starting to open back up a little bit, and we're starting to see some recovery in some of these sectors. I mean, ExxonMobil's had a nice little recovery as well. But we still talk about the stay-at-home environment because people naturally are going to be a little bit less willing to go out, a little bit less willing to be in social environments. And looking at companies like, anything that's distribution related, done really, really well. Technology, healthcare, biotech, consumer staples. So potentially wanting to bias your portfolio into the areas that are going to continue to do well. And again, some of that is a perception orientation, but we can look at it from a relative strength perspective and make those types of decisions. I'm being very cautious not to talk about any one particular company or make a recommendation because we are recording this, but I'm happy to have a discussion around investment strategy one-on-one. All right. And with every one of these, by the way, there's pros and cons. So, with annuities, for example, I think the big con is the fees. I don't necessarily mind the conservativeness of them because ultimately there is appropriateness to having a guaranteed cash flow stream, but the fees are pretty high. With bond ladders, ultimately, you are subject to whatever interest rates you're going to get at that point in time. Right now, rates are very low, so they're not tremendously attractive. Big dividend blue chip stocks. Now, again, it's a great cash flow strategy, but it might not necessarily follow suit with the market, and you are going to have equity risk. Modern portfolio theory, more passive approach, to me, the risk really is the liquidity strategy. There isn't a way to generate cash flow off of those approaches. And dynamic absolutely can have risk with it. For example, you could ultimately reposition into the wrong sectors, or if risk management really is something that's important to you, and if it moves you to cash, and then all of a sudden we have a recovery like we have now, well, goodness, a lot of people who went to cash in March, they've missed one of the best recoveries we've seen in the last century. And I'm not saying we're out of the woods, by the way, because I don't think we are. I think there's more volatility ahead. But ultimately, Yeah, the point is that with the portions of your portfolio that are designed or supposed to, their intent is to be more long-term, we need to maintain that investment strategy as well. All right, I'm going to transition, talk a little bit about withdrawal strategies. And you know, one of the most simple to describe is an income-only approach. And this is where you're only withdrawing interest and dividends from your investments, pure cash flow. It's very easy to do. The next is talking about a bucket approach. And this is where we set up specific buckets for different phases, different periods of time in your life. And then lastly is systematic, which is where we're just taking a prorated amount out of a balanced portfolio, no matter what the accounts are doing. That's really appropriate for something that's someone who's more in that passive strategy. So in terms of managing distributions, you know, we really are keen, and we talk a lot about tax strategy. We talk about a lot about reducing tax burden. And so, you know, when we talk about distribution strategies and understanding timing of where we should take money from, you know, the best rule of thumb is to live off of non-qualified after-tax assets first. Then we transition and talk about qualified. So qualified would be IRAs and 401ks. And then lastly, it's Roth IRAs. And I'll touch a little bit on tax today, but we've got whole presentations on this and some of the tax strategies. But one of the biggest things that we want to be doing, especially in the early years of retirement, is managing required minimum distributions. For anybody who doesn't know what these are, it's at age 72, you're forced to start taking money out of retirement accounts. And it's a percentage that increases every single year. Now, again, this is the required minimum amount. You can always take more out. But if you don't take out the required amount, there's a penalty. It's 50% plus you got to take the money out, so you're going to pay tax on top of that. So it's really important to talk about cash flow strategies. And one of the reasons I like living on non-qualified or after-tax assets first is because it allows us to manage our tax obligations, because then we can look at things like converting over from IRAs to Roth IRAs, because IRAs are subject to these RMDs, Roth IRAs are not. And so having an ongoing cash flow strategy is really, really important, but also having a tax strategy is equally as important. And here's just kind of a quick model of what RMDs look like. So RMDs did just get recently reformed. The Secure Act at the end of the year moved the starting point age from age 70 and a half up to age 72. They have not yet officially changed the distribution schedule. There's a proposed change in place, which will reduce the percentage a little bit, but that is not passed through Senate yet. But as it stands today, at age 72, you have to take out about 3.9% of your retirement account balance. But one thing that's important to note is that percentage is increasing every single year. And that same goes for that new strategy as well, but the new distribution strategy, by the way. They're increasing every single year, to the point where someone's getting into their late 80s, early 90s. These RMDs get really, really painful. And what happens is if you've got other money to live on, or you're extremely fiscally conservative and you don't need to spend that much, well, it's actually forcing you into higher brackets. And if you look at the percentage of what you're pulling out versus what your effective tax rate is, I mean, it's not out of the question. I've seen a bunch of cases where people are effectively paying 125, 130% in taxes because they spend so little, but the required amount is so big. The tax bill's bigger than what they want to spend. That's painful. You know, and so one of the strategies we talk about is bracket bumping. And we look at early years where we can manage cash flows, where you're going to be in lower brackets, and we consciously make the decision to convert money from an IRA over to a Roth IRA. This is just an illustration of one that we did for a customer where when they retired, they went right into a 12 and 10% bracket. And then immediately what we did was we modeled, all right, what if we just converted and kept them in the 24% tax bracket all the way through up the end? And what you'll notice is we were able to keep them out of these higher tax brackets later on in life. You know, they jumped as soon as they turned 70 and a half, or excuse me, 72, they jumped into the 32% tax bracket and then started climbing into the 35. Well, with just doing a little bit of bracket bumping, meaning you're paying some taxes now, they were able to stay in the 24% bracket significantly longer. And this is why when I kind of introduce Bogart Wealth and who we are and what we do, why I believe it's so important to have a tax strategy as part of your overall cash flow and withdrawal strategy, because we got to understand how can we reduce not only current tax burden, but also lifetime tax burden. And there's an equal amount of influence. And in order to do so, you need to understand the taxability of the different buckets, where when we do things, what the tax implications are. So for example, Social Security, 85 cents of every dollar is treated as ordinary income. Pension income, interest income, IRA and distribution income, those are all treated as ordinary income. Dividend income, long-term capital gains are all taxed at capital gains rates. Roth IRAs are not subject to tax, and liquidation of investment principal. So if you've got money in money market accounts, for example, that's not subject to tax. And the reason we talk about all of this is because we know our current tax rates go from 10% to 12 to 22 to 24 to 32 to 35 to 37. We also know that capital gains rates go from 0 to 15 to 18.8 to 23.8. Well, this leads to some planning strategy, right? So if we know in our future tax rates, for example, we're going to be in the 32, but right now we're in the 10, why not a 10 or 12? Why not convert portions of the IRAs over to the Roths while we're in these lower brackets so that we can avoid some of these higher later tax rates? Another strategy, which I haven't spent a lot of time talking on today, is maybe we can harvest going after 0% long-term capital gains rates. Well, in order to do so, your taxable income needs to be down below it's $80,250 for 2020. And ultimately, someone might say, well, I need a lot more than that to live on. Well, again, if you've got money sitting in a checking account or a money market account, those are ways to generate your cash flow. So let's say you need $150,000 a year, so $12,500 a month. You've got 150 grand sitting in a money market. Well, just by setting up a transfer from your money market over into your checking account, that's not creating taxable income. That's actually just setting up your paycheck. And ultimately, we have to look at the tax strategy in its entirety, because if you've got some highly appreciated positions, maybe what we do is we look at selling them in low tax years and go after the 0% capital gains rates. It's another strategy to consider. So point is, integrate cash flow strategies, withdrawal strategies with tax. Really want to make sure that you're understanding the long-term tax implications as well. All right, and then when we transition into kind of this maintenance mode, this is where we review and monitor the portfolio. So this goes whether you're still working, whether you're already retired, but we want to look at assets. How are assets performed? Are they higher or lower than we projected them to be? If you're still working, how is your income? Was your income estimate correct? Did you receive any unexpected cash inflows? And then also, very importantly, how is your spending? How did you do versus what you anticipated it to be? How did portfolio performance do? Was it higher or lower? Do we need to do some rebalancing? And what is your actual effective withdrawal rate? I'll talk about that a little bit more in a second. How did inflation impact the overall? And then lastly, have your retirement goals or expectations changed? And again, that can be before or after retirement, because they do change. So when we talk about that sustainability of the paycheck and withdrawal rates, this is a really healthy benchmark to look at. And this is an illustration just showing a portfolio that's growing at 5% a year with a 2% inflation rate. So that's a 3% real rate of return. But if you're actually withdrawing 3%, you'll see that it actually looks like your portfolio will last forever, continues to go up. Well, that's not actually the case. A 3% withdrawal rate means that you've got about a 99-year sustainability on your portfolio. So if you're retiring at 60, you're probably in pretty good shape. That's a joke. But if you have a 4% withdrawal rate, about 43 years, 5% withdrawal rate is about 29 years, 6% withdrawal rate is 22 years, 7% withdrawal rate is about 18 years, and an 8% withdrawal rate is about 15 years. So it's important to understand what percentage of your portfolio you're drawing out on, because if you take out money early on, that'll have material implications later on in life. And this is really more of an illustration. But we do look at withdrawal rates, and that's why going through and doing a financial plan is important, and having cash flow strategies and tax strategies and investment strategies, those are all important. But you've got to use that as the ultimate benchmark for success. Bring the plan back out. Part of our process is we're constantly bringing those plans back out to look at how we're doing relative to those plans. And then as we get into creating that retirement paycheck, you want to have and understand, starting with a reasonable initial withdrawal rate. We want to build a foundation from a cash flow perspective for those essential expenses, and then have withdrawal strategies for the discretionary expenses. And then we want to use a diversified portfolio with some downside protection. Then we want to implement some various different spending and withdrawal strategies, and then have those essential expenses covered for your lifetime with those cash flow streams. That's going to dramatically increase the probability of success for someone who's retired. And then constantly we're asked the question of, well, when do we adjust? When do we adjust our spending or our withdrawal strategies? Well, if we've got a great year, if your return or your portfolio is positive, then maybe we increase it by inflation, but we put a little bit of a cap on it. Might be 6%, for example. So we've got a great year. It's okay to spend a little bit more, but don't go crazy, because ultimately we are going to have bad years. And if we've got a negative year, maybe you don't increase by even inflation that year. You help absorb some of it. A lot of our clients in the month of March, because of the way portfolios were doing and the volatility, some of them just said, hey, I don't need my paycheck this month. And some of that was because of the nature of the stay-at-home economy. People just weren't going out and spending money. I mean, that happens too. And then when it comes to withdrawal strategies, where or how we generate the paycheck, interest and dividends, income from those needs to go out first. And then we need to look at asset classes that have positive returns, and we'll look at equities before fixed income. Then we come back and we look at cash withholdings. And then the last place that we look at is anything with negative returns. And then it'd be bonds first and then equities, just as kind of, again, some general rule of thumbs. So it is very complicated. You need to have a plan. As I said at the beginning, we would love the opportunity to do a plan for you. Absolutely no cost, absolutely no obligation. Some of the things that we think are important in terms of understanding an advisory firm, first and foremost, if you're interviewing advisors to help you, they need to be fiduciaries. Transparent fee schedules with no level of conflict of interest. We also believe that they need to be certified financial planners. We think that they need to know your ExxonMobil plans. We also need to know the IRS rules around them. Net unrealized appreciation is a very important part of that as well. We believe they need to have over 15 years of experience. We think they need to manage their own portfolios. Also, we think it's important that you can discuss various different strategies, that they're not just only set on the one investment strategy or the one financial planning strategy that they're comfortable with. Be able to talk about several different ones. We also think that it's important to track performance versus the plan, as I mentioned, kind of with that monitoring portion of the retirement strategies. We need to bring that plan back out, and we need to be able to have that plan ultimately as the baseline. And then lastly, can you understand them? Our job as financial planners is to be good translators for our customers, and being able to articulate clearly, but also transparently, what different things mean and what the implications are along the way. So that's just our list as we're thinking about those that are interviewing. Did have another question come in. Another financial advisors use the term family index number as part of their vernacular. Could you comment on this? I gather the concepts you indicated on how you plan to live your retirement go into this number. How do you see this number changing, if at all, as you move through the various stages of retirement? Don't recall Bogart using this term. I've heard family index number multiple times, and ultimately I have seen different advisory firms interpret it differently. I don't necessarily want to speak to that particular firm that you might be questioning, but to me, family index number is ultimately talking about what you're spending and how that spending is changing throughout your life. Now, part of what we do with our process, and as we're modeling out someone's spending, is I really do like to get very detailed in the nature of the spending. So we'll look at, for example, how healthcare is impacting a person's financial plan. We'll also look at, for example, travel budgets. So like if someone's retiring at 60, it's very common to see us do a very heavy travel budget for the first 15 years and then phase it down. But there are certain baseline level of expenses, those essential items, the food, the medical, housing, insurance, all of those have to be in there, and we have to be inflating those up. But I think it's extremely important to be very honest and very clear about what your spending is and what you want it to be, because spending is ultimately one of the biggest aspects or variables in anyone's financial plan. I'd rather go a little high on the projections of what we want to spend and model it that way, then go low and then ultimately be surprised on the high side. Now, there are some risks with that as well, though, because as we're modeling out a lot of these tax strategies, it's really, really, really important to understand how your spending is going to increase in the future, because that does have a manifestation of what we believe those required minimum distributions to be in the future. And so we're wanting to model that out on a year-over-year basis. And that comes right back into that monitor and review process, and why, as we're sitting with clients on a quarterly, monthly basis, whatever it is for them, we need to bring the plan back out, and we need to see how the plan is actually manifesting relative to the exact situation they're in. So part of what we do for our clients is we build out a tax pro forma every single year, and it's helping us with modeling what are the implicit implications of where we're at today versus where we're going to be in the future. And so if, for example, I go back to, if we know we're going to be in the 12% or even the 22% bracket now, clients got assets that we're not necessarily even remotely spending down. We're seeing them continue to grow. Well, ultimately, that's going to be one of those great scenarios of why we really need to look at some of those Roth conversion strategies, or potentially looking at some tax loss harvesting strategies and ways that we can help improve not only the current environment, but projected future environment as well. Can you show the slide again on average spending needs during retirement? Yeah, absolutely. I'll kind of zip back to that one. So, you know, again, this was a slide that was modeling different phases of life. And ultimately what it's also trying to do here, and again, it's showing the national median. So I recognize most of the households that we're talking to are bigger number than that. But ultimately, you know, it's important to talk about what categories of your spending are most likely to increase at certain periods of time, and what categories are most likely to decrease at different phases of life. And this kind of goes back to that family indexing number and how we build those out within a financial plan. Some people want to just kind of lump everything together. Some people want to get very, very specific in those numbers. You know, we're flexible in that regards. You know, I do like to get a little bit more specific and model out different scenarios. And part of a planning process to me is not just here's one version of the scenario. We need to look at a plan relative to 3 or 4 or 5 different scenarios. It might be timing, it might be spending, it might be some different variables that we want to look at. Like on the baseline, we're going to look at lump sum versus annuity. We're going to look at a 58 retirement versus a 60. You know, and some of the things that we see are key themes or recurring themes within anyone's financial plan. You know, people retire when they've got something that's more important to them than what they're currently doing. I also think that it's very, very, very important to understand that, you know, kind of the basic mantra, you know, the financial advisor in us is going to have you work longer. I mean, the longer you work, the better anyone's plan is going to be. A joke that I use a lot, and some of you have heard it, is the financial advisor in us is going to have you work until you're 80, you die at 81, your plan's going to work great. We'll also have you save every dollar you make and leave nothing left to live on. That's going to make the plan work great. But ultimately, there are emotional pieces of this that have to come back into any of these decisions as we're making them. I had another question come in. So does the average spending needs slide consider these numbers are after tax? Yeah, these are after tax expense numbers. Yeah. Yeah. All right. By the way, I did record this, and I'm more than delighted to send out the slides if you'd like them. Mindy and my team is going to follow up afterwards, and I'm more than delighted to hand those out. I did want to kind of just wrap. Ooh, went too far. I did want to wrap up a little bit today and thank you all for joining us.